Welcome to this Wyckoff Starter Kit part of the series. This series lecture will deal with the process of the trading range, and we will do 3 charts to illustrate this on the daily, the daily time frame and the weekly time frame as well. And it's very important to note that the trading range is something that is extremely critical aspect of Wyckoff because it directly relates to the Wyckoff principle of cause and effect. The longer the sideways of a market is, the longer the potential move can be. And we will show that in illustrations today. So it would be akin to a car that has a quarter tank of gas versus a car that has a full tank of gas. Obviously, the full tank of gas will give more, will lead to more credence of the larger move or the larger distance that a car can travel. The same thing with markets. We calculate how far a market can go, generally by point and figure chart, as a guesstimate, not an exact science of how far a potential move could be. So in this particular charts that I'll be showing today will be illustrations of where we have to adjust our lines according to the market's behavior. And that's something that is extremely important when you look at markets, is that lines are drawn, but as the markets go through these particular lines, they get redrawn. So they're living and breathing markets. They're not always so static. So we need to adjust our lines according to what the market story in the background tells us. If not, we lose control of the story because the lines that we once drew no longer become valid. And if we take them as being valid, that may be furthest from the truth. So we cannot put ourselves in a situation where, since a line is drawn, that we keep that as the gospel and truth. So let's begin with our trading range, and let's begin first, before we get into this, with our disclaimer. There's substantial risk of loss of trading futures, commodities, and options. Past forms are indicative of future results. The expressed are carried for the LTG LLC and not to be taken as a recommendation to buy or sell commodity future options for educational purpose based upon the teachers of Richard Wyckoff. So, as we can see, and as we usually will start, we will start from the left-hand side of this particular range, and we will see that the market is in a downward progression, a downward channel, or during the markdown phase of the particular market. It is when the market gets the first decent reaction from the low in this point that we like to see the market behavior such that we will see the market then form some type of low. This low could be intermediate. This low can be change a trend direction. So we have to see how the market behaves the subsequent action after it. So we want to draw our lines in our trading range from an area of the support of where the demand comes into the market or where the stopping action comes in. So we can see a mid-range close here, and over the next subsequent bars we begin to have a rally. Because of this rally here, we can now draw our line of support at this particular low going across. And what's important about trading range, to Wyckoff, these horizontal trading ranges is where we find our demand and supply from. They are not from our sloping channels that maybe people are used to, or a sloping line, trend line. Those do not show you demand and or supply. The only way that you can see the demand and or supply is from the horizontal trading ranges and how the markets react from each subsequent trade of the creek or of the ice area. That is very, 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 very important to understand that aspect of it. We get our demand from our ice support from the lows, from the buying area, and we get our resistance from the creek or the selling areas of the top of the range. This market begins to go higher and all of a sudden the rally continues, and usually the rally will continue either with some resistance on the left of the chart or some stopping action. The market continues higher, and then we draw our line according to here, because this is a market in which the market subsequently had gone up, stopped going up, and went back down, and the market reversed. So now we have a situation where we form the low end of the range based upon stopping action, and the high end of the range because that's where the market topped out from. We could establish this as our creek resistance. We could identify this as ice support. We draw them horizontally. In Wyckoff's world, he drew them almost as a squiggly line. This is some type of average we took. But for practical purposes, we draw them as horizontal straight lines. So the market goes through the process of rallying from the short covering rally and people covering the market that were short, and maybe people trying to pick a bottom in the market by trying to see if the market starts to go higher, they begin to buy the market. In this case, there's no volume. I want to focus in on just the bar behavior of the market because we'll be able to see a lot through that. The charts will show with volume as well, but I want to just focus on the particular action of the trade itself. So we can see the market has a reactionary low, and then we can see the market has a reactionary high, this aspect. The market then goes through the process of rallying. Then the process of the market then tends to go lower, the retrace. It is at this point where the market has begun the left-hand side of the trading range. Okay, is this side here where the market first gets the reaction from the down move. It's the first reaction that goes up that could form the potential left-hand side of the trading range where the cause is starting to be built. As the market goes across and goes across and goes across, it develops into the right-hand side of the market. Okay, how long that lasts depends on a lot of different factors. Okay, but at this point, it can last for several hours, it can last for several days, it can last for several weeks, it can last for several months or several years. There's no set time to what happens to the market as far as that goes. Okay, so the market then gets to the point. The market then gets to the point to where you get to the point that the market reacts back down, and we could expect the market to go back all the way. We expect the market to be at a point to where it could spring, it could go not all the way. There's really no set criteria to what happens. What we do know is that during this trading range that occurs, is that the closes mean very, very little to the market until you get to the right-hand side of the range. Meaning, strong closes don't really necessarily have follow-through, and weak closes don't necessarily have follow-through. A weak close does not have follow-through. Okay? So, a strong close here doesn't have follow-through. So, what is important to understand is that the market within this trading range is at a point to where it's called back and filling within the range. It's back and filling, back and filling, back and filling. Buyers and sellers, buyers and sellers is what we refer to in the industry as back and filling of the market. I mentioned this many times to people that we do the one-on-ones with. It's kind of a situation in which you may love sausage, but you may not like how the sausage is made, but you like the end result. You may eat at your favorite restaurant in the world, or a favorite restaurant in your town that you like to go to town. I'm not necessarily always think that the meal is always prepared with the most sanity thing in the world as far as that's concerned. As long as it tastes good, and that's really what happens as far as you're concerned. But maybe how it's made in general, situation-wise, it may not be something which may be appetizing. Don't boycott your local restaurants, but who knows, okay? So, the high-end closes, low-end closes don't matter as far as that's concerned. This may be stopping action on the short-term basis, but it may not mean nothing in the whole scheme of the particular trading range, okay? This doesn't matter a heck of a lot to what happens. So the market goes through its duration as to what happens. In this particular case, we keep getting a retest of support and retest of some type of resistance. So what we have here is first we also can have trading ranges within trading ranges. So when the market made a high here, then we had a demand bar that came right in here. So we can mark these almost as minor type of trends, minor type of retests in the market. And we could also draw here, obviously, the market stopped by here, and we could also draw this aspect of the market. Okay? Now, when we deal with lines, we don't have to be something that is exact in nature. In other words, there's a lot of black box systems. If the market goes one or two ticks above support or resistance, that may trigger a particular trade. That may take a particular trade to what happens. And it may not. But what happens is that we want to see these ranges and their minor trends in a situation where there's more major ones. I'm sorry, not trends, but trend lines, okay, horizontal lines. So we have a trend line within a trend line. Let me draw this a little bit more straight. We don't want to be sloppy here. We draw the line exactly across here. Okay, and that's what we have at this point. So we're worried about the market movement in the trading range from the standpoint of that we get to the right-hand side. We would like to see the market exhibit a large bar with large volume on the right-hand side, either giving us the sign of strength, which would be a large up bar with volume, or a sign of weakness that would create a downside pressure upon the market. In this case, we will see the market back and filling, as we mentioned before, and we will see the market as we have some type of spring potential in the market right there. So let's just mark that for our situation. That's a possible spring that could occur in the market. In Wyckoff very much like springs that had a small penetration of support that went above that penetration of support versus the wide swinging spring. The market goes way under support and comes back through it. He liked when the market just kind of nudged underneath a support in the particular market, which you see the case here. The importance of the spring of the trading range is to see the follow-through of the market. If this spring leads to that sign of strength on the right-hand side, then we have a situation to where the market can go higher. Okay? So, and then take out and make new highs. So, we judge the reaction to the market then rallies, market comes back, then we have some type of spring, and that spring is created many times to wipe out some of the weak longs underneath the supports. It's also a situation where it gets also people short the market. It's more fuel for the market. The market then has a situation where it starts to head higher again, and no difference than what the market has done in the past. The difference is that now the market, as the further it goes to the right-hand side of the market has formed the right-hand side of the market, and also that is that the market has now more cause built. So not only on the right-hand side, it has developed the move that's been many, many, months in the making. Many months in the making. Okay, so that's why the situation is important, that you get more and more situation on the right hand side, the larger the move becomes. So we're looking for some type of change behavior on the right hand side to have markup begin. That usually on the CM talks to each other by the sign of strength or the sign of weakness that occurs in the market. So we've been down this path before over here. The difference becomes is that when this market tried to mark up on this particular bar right here, the market closed on the week as a rejection of this price. Okay? In this particular market, the market basically stayed fairly stagnant. It didn't rush up like this, and the market then had a large bar to the upside that took out this resistance area. Okay? This is what we consider demand, and more so, we consider this the sign of strength on the right-hand side of the market. It's characterized by the large move to the upside. It's a market that goes above this creek, also this minor creek will play. This minor creek that occurs, the minor creek that occurs, and goes above it, and this is a spring. We'll just call that a minor ice. There's no term minor ice, but I'm just telling you the difference between more important ones. Okay. So this is on the right hand side of the trading range that shows a sign of strength on the right hand side of the market. If you will notice, the character of the rally is much different than the other portion of the rallies. In other words, when the market went up here to this level right here, you'll see the market got an immediate rejection of price. When the market retested, you got the immediate rejection of price. When the market went up here, the market did not get any rejection on price. As a matter of fact, the market closed on its highs. Okay, so that is very, very important. So the difference of the character on the right-hand side of the market shows us that the market is at a point to where the market is ready for markup. That's how they look at that from the right-hand side of the market, where you get that sign of strength or the sign of weakness that occurs in the market. Okay, so this character on this right-hand side, if we were looking at, if there was a volume, and the dollar index doesn't really trade with high volume, the volume would be something of this nature as a sign of strength relative to the background being like this. Okay, so that's what it would look like from a volume standpoint as far as that's concerned. As a matter of fact, let's see if I can put the volume in. It doesn't make sense. Put the volume in. See if they do show anything like that. Usually the volume on this dollar index is very poor in quality. I don't tend to use it that often. Actually, it's a little bit better than I thought now that I redo it. So you can see that the market does get that increase in volume to the markets. That's why. Okay? But sometimes what happens in markets, you get rollover volume that happens in these markets. As we looked at the markets, you see these rollover volumes that occur, and you see that the market tends to, here, December rolls over to March, in March rolls over to June, so sometimes the volume is misleading as far as that's concerned. Okay? That's right. So that's why it's very, very important to sometimes to realize in futures we get rollover basically every time the contract goes to a different month. Okay, and that's why it's sometimes difficult to see the true volume to what happens many times as far as that goes. Okay, so we'll put the volume in, even though it's very sometimes misleading. So the market has this strength that occurs in the markets. Then when the market eventually retests this particular area, this reactionary high that occurs, if the market has a point to where the market had resistance at one point, that the market retests this high that went down to the lows, we now want to see the market, if they were selling here before, if it was selling there before, that occurred in the markets. That would stand the reason that the composite operator defended that resistance area, that the market would come down from that again. Well, we now see the market has resistance, and we see on the right-hand side of this range that after the market has this wide range bar, we could see this sign of strength bar, instead of getting sold off as possible maybe an up thrust or negative behavior, we now see that the market basically had a situation where the market maintained the integrity of the gains, and that is absorption to go higher. In the starter series kit, we discussed the absorption to the upside and to the downside. So that's part of this series. So what happens is that the market then has that sign of strength, happens on the right side, and now we have a situation where we have this cause that is developed in the markets. Okay? And so this spring that we have is called a terminal spring because it's the last spring before markup. So we call that a terminal spring. It's the last spring before the market actually marked up. It's clearly the case here. But if you notice, this trading range happens to be in the market in which we see the sideways behavior of the markets. We see that the market had a weakness in the background, but we're able to see the market able to withhold not withhold, but they're able to handle the gains of the market until we get to the point that we get to the right-hand side of the market and shows us the sign of weakness. And that's very, very, very important. Can this market be in a trading range and show a sign of weakness to the downside and cause markdown and distribution? The answer is yes. But once we see the market get to the point to where it shows that sign of strength on the right-hand side of the market, this is essentially what this is. It's on the right-hand side of the market. Once we see that behavior happening, then we can get to the point. Then we get to the point in which the market is ready for the mark-up phase. Had this market been to the downside, this would have been distribution to the downside phase. The fact that the market was able to be at a point to where the market rallied, strength, and the speed of this right-hand side was decent, okay, then we get to the point to where the market then rallied up, showed the strength. The market did not get any selling off. Part of the market absorption process, the market went to a high, and what's important about this particular chart is that then we will form another trading range that will occur in the market, another trading range that will occur in the market from this reactionary high, and you will see that when the market went down to come down to test, it came down to test this creek resistance perfectly to a T. Okay, this is the area that you'd want to enter the market. This is your buy edge in the market. It's a shortening of the downward thrust. It's a shortening of the downward thrust, as well as a retest of the previous high resistance that becomes support, and then we form another trading range. Let me clean this up a little bit here and make this a little straighter for our lecture. So we can see that this new trading range in the market has now gotten to a point to where the market has formed a new trading range, and then the market plays around and goes down, but we see that the market reacted very nicely to a nice trade. Once the market got back on this level, you would exit the trade as far as that's concerned. Okay? So, very, very, very important. And I mentioned something about these little trading ranges that occur in the market. And so what we see is we have a trading range that occurs. You see that? Then we see another trading range that occurs here. Okay? So what happens, and what's important, is that when we look at trading ranges in part of the upside progress, we will see a trading range that will lead to the strength of the market, trading range that will lead to the strength of the market, trading range that will lead to the strength of the market, and that is part of the markup phase that we do and look at the market. We could also look at this as wave structure. Something like this nature, where this forms this little range and then markup, little range and markup type of thing. So we can see that from the aspect of this sideways trading range that occurs, and this is how we have that zigzag type of formation. So we have this type of activity, boom, sideways, okay, or the zigzag with the markup, little retracement form this little range, and then markup goes through. So many times boxes will form these, many markets will form these trading range boxes, and then eventually you'll see supply come to the market. Then this will form a lower trading range box, which would be distribution to downside. So as you could see, that the market will spend most of its time in this trading range, most of the time in this trading range, only a small portion out of the range. So we always want to look at the trading range, see how the market acts and reacts in the range before it goes higher or lower. Okay? So that's very, very important. As long as we don't see any weakness in the market or stopping action, then you'll see how the market does. But you need to see the market's in a supply market, see supply, then this area here, this box has become distribution to go lower. But you must have supply to come into the market, as far as that's concerned. So markets form in boxes, as well as markets form in wave structure, as we said, those boxes here. So the markets, I would say probably 70% of the markets will stay in some type of trading range, in my opinion, and those trading ranges will lead to a market that will either mark up or end up marking down as far as the behavior happens in the market. Clearly, in this chart here, you can see the sideways behavior that led to markup. Okay, And if you look over here, currently the market is trading at 92, 95 area, way up here. Okay, so there could be some bumps and roads in this trading range. The market may go lower than we saw briefly on the chart, but ultimately the bulls are in control, and we'll go from there. So you have to see how the market ends up getting to the level to where the market continues to be trading ranges. So this is a pretty. We know that the dollar index has been pretty strong, and this dollar index has done very well over the last year or so. You can see what the preparation phase of those trading ranges. And the key to this chart was the fact that we were able to have a sign of strength on the right-hand side that led the markup. That's an important part of the market. In a market that's going from a bearish market, we have here the market must have a sign of strength on the right-hand side. If the market was an established uptrend, you do not need to see a sign of strength to go to the upside. You do not need to see a sign of strength in the upside in an established uptrend. Conversely, in a downtrend, you must see demand, a sign of strength in a downtrend, but you do not have to see a sign of weakness in a downtrend because the downtrend has been established. In this case, you must have a sign of weakness to turn the market down because the market's path of least resistance is up. So you need a sign of weakness in a bull market, and you need a sign of strength in a bear market to have a potential change of trend behavior. So we conclude this section with this chart with the dollar index, and we will do a couple more charts in this lecture. This is the Dow Jones Transportation Index, and the reason why I did this particular chart is because we have seen the price of crude oil come down substantially over a period of the last year or so. And when you have lower costs for crude oil, it affects the market in the transports, the trucking, in a very, very positive fashion. So I wanted to show this chart as a trading range, but I also want to show it as a money flow type of situation because I can correlate and kind of throw two different Wyckoff ideas at you at the same time, and so that we can get multiple thoughts on one particular chart. So this is a market that was going down as well, and the market went to the area in which it tried to rally the market quickly. We know that we don't want to buy the first rally in a market that's going down. We want to wait for the market to get some type of secondary test. In this particular case, we see that the market ended up going to a lower low, but trying to form some type of stopping action that happens. So when the market has this stopping action that occurs in the market, we will see the rally that occurred. Okay? So the market had stopped going down and established some type of rally in the market. Because that's the case of the market, we could draw our lines from the support area here. Okay? Support area here. And we could also put the market as, again, from this area that the market has some potential action-wise. Okay? Market reacts decently. This is the first decent reaction. This downsend, we have to mark that. The market has stopping action. We now see that the market has supply to the downside, we like to mark this as our resistance line, because even though this market, even though the other examples we did high off the high was a range, but this was a more of a supply bar. It was a wider bar as well. If you want to put it for reference to this as well, that's acceptable as well too. But this is a more important line, so let's just keep that more important line in the way that we do it, the way that's easier to be seen from the market that has this. The greater the reaction bar-wise, as far as that's concerned. Okay? So, we established the low, stopping action, and demand. We established a high, stopping action, and selling back down. So the market then, it goes through the rigors of the trading range to build the cause. As you can see, the erratic movement, again, within this particular trading range, where you'll see a low-end close, for example, really not lead to selling, market low-end close not really leading to selling, a high-end close kind of not leading to buying, and the market goes back and forth, that back and filling process that occurs. So what we see is this market goes through the trading range. Now, many times this trading range will end, like you saw in the last example, end in a spring type of behavior. I showed that last time, that Wyckoff like that small spring. So many times when you see a small spring in a market that's in a trading range, okay, that is something where your entry point, your level of knowledge is great, because you have a very low risk, large reward trade. If you're buying a small spring, a market that's in an uptrend, small spring, you put your stop underneath a vertical demand bar. Springs work in uptrends, they fail in downtrends. So we see the market back and filling. We don't really see any great demand in the market here. So generally, when you don't see demand in an area of support, generally that market has a situation where the market tends to get to the level to where the market is at a point to where the market has to go up and eventually retest lower in the market. Retest lower in the market. So this is a poor quality type of rally, even though it led to a rally, but we know that some type of retest would happen, and the market then does retest. Now in this case, we have something that is a weak quality. It's a weakness bar, so we just can't buy the ICE support until we see stopping action. Stopping action would be a spring of a previous low that closed above that low, or a market that has a shortening of the downward thrust. Well, in this particular case, the market has weakness. We have to wait, and now we see a bona fide spring action behavior. The market penetrates the demand bar and forms a spring. So this is a vertical. This would be a vertical demand bar. This is a vertical demand bar that occurs, and what is very important about this vertical demand bar is that vertical demand bars tend to get retested, and conversely, opposite, vertical supply bars also get retested. They provide very good edges for the market to do that. Okay? For the market to do that. That's why. So retest of those areas that are very, very important, especially when they end up retest of vertical demand bars are very important when they show some type of ending action. A spring is one of those types of ending action. Again, we have the left-hand side of the market, Doesn't matter, right? This just established was the left-hand side of the market. As the market goes, keeps going. The right-hand side keeps going until the market would have been at a point to where the market's trading through this range, and the larger the cause that we have developed in this particular market, the larger the potential move. Larger cause, larger move. And we see the market goes forward. We see the market goes back to that spring level. We see the market go higher. It's higher. It's higher. Now, very, very important aspect of the trade is that we now see the market get to the point to where we have some type of market that has this spring again, okay? It has this is that spring that occurred on the bottom of this range, and we can see the speed is fairly quick, faster than any speed of the rally before. So even though we want to see a sign of strength that would occur in the market, which would be needed for the market to do that, okay, we also tell us that this is some type of strength as well, too, and some type of vertical absorption as the market's going higher, okay? Typically, we did not see the sign of strength bar that normally typically would see with this particular thing, which needed for the uptrend, okay? In this particular case, this market's already in an uptrend, even though this was stopping action at the beginning of the market down here. This market was an uptrend in the transports. You know, trying to show the trading range at the higher prices. So in effect, we don't need that particular sign of strength on the right-hand side, as far as that goes. So, which is why you don't see the sign of strength on this particular bar, because the established of the market was to the up to the market. So we now see the market staying on this market. Now, typically, when we see this market behavior here to be absorption, we need the market's generally in absorption phase. And we show this in subsequent newsletter. Lecture-wise, the market would stay high-end to mid-high range in the market. In this case, we did not do that, okay? Which kind of makes a negative statement in the market because of the closes, for the most part, and nothing is foolproof. But what's key is, and this is very important, which I think is probably more important at this juncture, is the fact that the market had a run-up in the market. The market went up in the market, established strength, but guess what? The market never had supply in the market. Right? That's why it's very, very important. So the market then has this vertical bar, vertical absorption bar, and it goes higher, and we leave this trading range, and the sign of strength that occurs here in the market is the jump over the creek area that occurs in the market. Okay, so we do eventually get that on the jump over the creek level, and that tells us that any of the weakness that we just had recently now becomes support in the market, and the market gets to the point to where it has this vertical absorption, jump over the creek, retest, back to the market in order to go higher. So it's not an up thrust, but about 6-7 bars, and continues on its merry way. So that's an establishment of the trading range that we see the sign of strength above the creek area versus one that happens in the trading range. So we can see a sign of strength happen in two places. We can see it happening only on the right-hand side of the market after accumulation. Okay, we can see it sign of strength in the trading range. We can see the market have the market have sign of strength in this trading range, or we can see it from the standpoint of the jump over the creek area. We can see it as the market leaves the trading range. Sign of strength is a term only used on the right-hand side of the trading range that has high volume and large range in it on the right-hand side that establishes demand and supply on the right-hand side of the trading range. Sign of strength is needed for a downtrending market, and the sign of weakness is needed in an uptrending market to show the change of character in the market, to show the character change. Okay, so we need to see that behavior, and this is an area, edge area, that you want to buy the market. It's a retest of the creek area, but it's also a retest of the market. We have that vertical demand bar, or the sign of strength bar, that gets retested. As I explained to you earlier, is the vertical bars that get retested are good areas of levels to buy the markets. There's clearly very little risk and a great reward to the markets. When normally we put our stop underneath we put it probably under this congestion here, because if it starts to take out these previous lows, the market probably goes lower. Okay, so this is a great illustration, again, of the market trading range back and filling. These closes don't matter a lot, even though this is not demand, so we will not buy this market because reaction was poor. We do get our secondary test, and the reaction is much better as far as that goes. So the greater the reaction from an area of ICE support in the trading range, the more meaning potentially could be. Market that barely dribbles off that level could be looking for more markdown. Market that shows strength in the area is probably the transfer of risk from the weak longs or the weak shorts into the strong longs. This market had moved up, and the market had moved higher. The market went higher. So understanding the jump over the creek of this trading range, the trading range is formed by the market going sideways after stopping action. The sign of strength led to a perfect retest right there, and the market went straight up, as you can see. So what's important about identifying these trading ranges and what they do is because of the length of this trading range, of the large cause that got built in this trading range. Once the market left the trading range, the market had enough ammunition and cause to continue to go higher at this point. So the market did not have to retest and build more cause in the market because the cause was already established. So when the market was ready to go in the ready position, this is what Wyckoff considers a ready position, where the market retested the area of the creek area, the area of the retest area, then the market was ready to go in the markup phase, the ready area, and the market never looked back. So that's why you're identifying it early, because you want to be there in the market. You want to be there when the market when the market begins the markup phase, because that way you don't have to make, that's one last decision that you have to make in the market, because you're already long. You're already long in the market. So the problem becomes the market needs to retest, show the strength, come back down to the creek area, and mark up and do very, very, very well. as you can see. So establish the market of a trade range, lower the calls, larger the move, and we don't necessarily have to retest. We can retest, obviously. We don't necessarily have to retest in the market. In this particular case, we didn't because the market was acting extremely well, and the market took off to the upside. So as you know, many are familiar with these webinars that I do, and those of you that just recently purchased it, thank you very much. What is very, very important is, and not important, but what I like to show is current markets. So when I do the one-on-one lectures and webinars for people, I like to use real-time markets because I think they give us the most most bang for the buck. I can always cherry pick things back in the market for me, and then the market, it gets to the point where we want to see live markets because we want to be able to put ourselves on the limb to use our Wyckoff knowledge to establish the position. So if I'm doing things from 1920, that doesn't help you now, but if I can identify it currently now for you, the market, then I certainly want to be able to help you that way too. So that's one of the reasons why the one-on-ones have been so successful, is that people are able to have the unlimited time with me, but they're able to talk about live markets that are there. So that's why. So that is why it's very, very important. Okay? So to do live markets. So this is a market that we went over, and this is important because it's an important trading range. So this is a market that is obviously, the stock market has been in a nice uptrend channel that occurs in the market. So we can see this uptrend, but then we get this market that's corrective in nature to the market. What's very, very important is that the market has the right to correct. Right? The market has the right to correct in the market. So once we get this correction, as we said several times before, this now becomes the left-hand side of the market. It's the left-hand side of the trading range. Okay? That's established market-wise. Okay? So the point is that the point of the market is that the market establishes higher, and we can see that this demand bar is where we want to mark our level of the market. Is at a point to where the market gets demand, and the market gets to the level, and it gets the market where the market gets demand from. We mark this level. Very important level of the market. When the market goes back higher, again, we establish from the selling area. We want to mark our area from the selling aspect of the market. So that not always is the high of the market, is not always the low of the market. In this case, that's what you see. Not the high end of the market and not the low end of the market. Okay? That's what's really, really important to see. People draw them always from the upside or from the downside. They'll draw it from here, but you can't draw it from there because there's no demand, and you can't really draw it from here because there's no supply. So the creek areas come from the area of selling, or supply comes in, or the buying, or the situation where the situation comes to the buying aspect of the market. Exactly. So it's very critical and very important to understand what those represent. Okay? Most people don't understand. But it's very, very small nuance simply because it makes your line placements draw better, as we talked about earlier. So if this bar would have been like this, for example, and closed this here, and then demand would have gapped something like this, we would not draw this as our thing. We would draw this area here because that's where the demand came in. So it's where the demand comes in that you want to buy, that you want to put in your ICE support or when you get clustered areas. So you get clustered areas like this, okay, then you want to put your resistance there, ice there type of thing, and your creek here because of the clustered highs and lows situation versus buying the market like this, putting the top end of the market, okay? So those are the two ways where you establish your ice and creek levels in the market. From the clustered areas or from the vertical demand and or vertical supply bars that occur in the market, okay? So, market goes higher, and what happens is the market then retests. Again, the closes do not matter in here. High end, low end closes does not matter until you get the sign of strength on the right-hand side or the sign of weakness. That's when the CM is ready to leave the trading range. So as long as the market doesn't have that demand or supply on the right-hand side of the market, depending on trend, then your market is really not in danger of leaving the trading range, right? Just doesn't leave it just sporadically leave the market-wise. So, in this particular case, the market goes higher, retests, and you see the volume, not volume, you see the market happens to have reaction pretty strong to the market. Market has pretty strong reaction from the bottom of that particular range, indicating the CM still has interest in buying the support of the market. Okay? So, the market comes back down again, and boom, we get a rally from it. So every time the market has gone down to an area of support, the market immediately perceived by the CM as being value, and the market then got to the point where that's the case. Okay? So, very, 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 very important. Very, 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 very important. Okay? So, market moves higher, and the key about this market is that this market now hovers in the upper third of the range of the market. That is absorption, and in the absorption section are going to show this more clearly, but the market does not back off from this absorption level, and the market then establishes to go to higher markets. This is a very important aspect of absorption, which gets shown in one of the other videos, as you may or may not have seen us yet. So, we see that the market in the trading range, we see the market rushes pretty good to the right-hand side of the range. We know that the market has established an uptrend, so we don't need to see that sign of strength, and then the market works higher. And this is just to throw it out there for us. This is a thing of vertical absorption in the market. Right? The market is going higher, absorbing, going higher, and that's kind of the beginning. It's not so much a markup phase. A markup phase would be a market that would do this. In a markup phase, you can start to see wide ranges on the upside. The vertical absorption will be something where the market's very minor. Okay, so that's a little bit different. So this is an example of vertical absorption. This is a matter of markup. They both go higher and they both mark up, but the terminology is still a tad differently as far as that's concerned. Okay? So this establishes a trading range. This now market takes out this particular reactionary high. We take it out. The market holds this situation where it holds low, gets tested once, gets tested twice. Both of these ranges after the test are bullish. Both of those tests, the range, happen to be bullish. And the market gets demand from lower levels where the composite operator does his business from the lower levels of the market. And the wide range high-end close indicates that the market is getting demand where there's value to them, and the market is still buying the breaks or buying the support, and the market's reacting well to that, meaning that buyers are overtaking sellers in the trading range, which leads to the eventual markup as long as there's no supply that comes in and has a change of behavior. So the market will continue to go higher until you see a trading range, until you see supply coming to the market and going back in that trading range. So that's very, very, very important about trading ranges. So this concludes the section on trading ranges for the Wyckoff Starter Series kit that we are doing, and the series of 6, and look for the other ones as well as 2. So I bid you a good day, and see you in the other lectures. Thank you. Bye-bye.